This is FRM Part 1, Book 3, Financial Markets and Product Mechanics of Option Markets. And this is another cool chapter. You guys that have been listening to me for the past couple of chapters will know how excited I typically am about any conversation that involves derivative securities. I love swap contracts, I love futures contracts, and I love option contracts because they have a couple of extra features. Now remember, in a swap contract and in a futures contract and a forward contract, whether we took the long or short position, we were obligated to do something, right? We were either obligated to deliver a bushel of wheat, or we were obligated to take a position in a particular interest rate. But an option contract is very different. It's unique in that the owner has the right but not the obligation, which means that the owner of the option has the choice to do nothing. Imagine how much more valuable our lives would be if we could wake up in the morning and just do nothing. Exercise our options so that we didn't have to go to work, or exercise our options so that we didn't have to go to school. Now, of course, the kicker is that you have to pay for that option. And I'm guessing that all of our bosses would charge us a big premium if they wanted to grant us the right not to show up on certain days. Anyway, let's get to the learning objectives. Just a handful here in this chapter. We're going to do some describing and some explaining. So let's go ahead and get right to a definition of an option. So there's what I said on that very first slide. The buyer of an option has the right but not the obligation to exercise the option. And more specifically, the buyer has the right but not the obligation to either buy or sell an underlying asset. And of course, by far, the most commonly referred to options are stock options. But as we'll see here, there are tons and tons of different kinds of options. All right, so before I go on, let me make sure you understand what's happening here. When you buy a share of stock, you go to the floor of the New York Stock Exchange and you're the buyer, so you have to find somebody who owns that share of stock. So the two of you get together in that secondary market and you trade, right? In the futures market, you go to an exchange or you go to an over-the-counter market and you find somebody who's willing to either buy or sell the underlying asset at some time in the future, right? But with an option and an option market, it's just a little bit different. Someone has to create the option. Someone has to write the option. Someone has to sell the option. And that writer of the option is just really anybody who wants to generate an income who's willing to take the opposite bet that the investor wants. So the writer of the option creates the option. They sell the option to the owner of the option, to the buyer of the option. And by the way, anybody can become a writer of the option, but I'm probably prevented from becoming an option writer, mostly because I don't have tons and tons of wealth. So the writers of most options are financial institutions. So if I show up on the options exchange and I want to buy an option, the financial institution will probably write it for me with the terms that I prefer, and then we'll have to agree on a price. Okay? So let's talk about premiums and gains and losses. If I show up on the options exchange and I want to buy an option from you as the writer of the option, and you say, sure, Jim, I'll sell you this option and I'll sell it to you for $10. Well, the worst thing that can happen is that the option finishes out of the money. We'll talk about that in just a minute. It finishes out of the money and I allow the option to expire. I lose that $10. So the most I can lose is $10. But if this is a call option and the underlying asset price, like a share of stock, increases in value, let's say to $100 and $200 and $500 and $1,000, the potential gains are, theoretically infinite, but I really don't know what that term means mathematically, especially as it applies to financial markets. Some big number. I mean, clearly you're not going to cash in for an infinite amount of money. Imagine how you would have to report that on your tax on April 15th. You bought at 100 and you sold at an infinite amount. Who knows what the tax penalty would be on that? All right, what that means then that for the writer of the option, the most he or she can win is the premium received. Because if I lose that $10, then the writer of the option gets to keep that $10, and that's the maximum gain. Of course, for the writer of the option, if the call option, if the price goes way up to $500 or $1,000, that potential loss is unlimited. There's a better word than infinite. All right, so make sure you get this. You have the option writer and you have the option buyer. These two people are really betting against each other. And so what happens? That the option writer is hoping to sell the option today for a premium, like $10 or $15 or $20, and then never see the buyer again. And if the option expires worthless, then the writer gets to keep that premium. And here's a picture, 4 pictures of these payoffs. Let me go back to that first slide. What did I say? An option gives you the right but not the obligation to buy an asset. That's known as a call option. An option that gives you the right but not the obligation to sell an underlying asset. That's called a put option. And so look at the top left graph for call options. If we buy the call option, that says that we are long the call option. What's the most we can lose? The most we can lose is that red parallel line to the horizontal axis. What was that number I gave you a few minutes ago? $10. So if the stock price at expiration is, let's say, $0 or $1 or $2, and you pay $10 for that option, then that's the most you can lose. But notice, as we move along the horizontal axis, if that stock price goes up and up and up, well, then the red starts to go up, and then it turns green, and there's that unlimited profit. Now, the writer of the call option is the short position, and so all you have to do is flip that. And that's why it's green above the horizontal axis, and then it's red going down below. Now, for put options, of course, what you're doing is you are betting that the price of the underlying asset is going to fall. So notice that the profit is going up into that northwest corner. And then if you flip it, you get the writer of the put option. All right, so let's go ahead and add another variable to this equation. What did I say? The buyer of a call option has the right but not the obligation to buy the underlying asset. You ready for the extra part? At a specified price. And that specified price is known as the strike price of the option or the exercise price of the option. The owner of a put option has the right but not the obligation to sell a share of stock. Are you ready for the extra part? At a special price. And that special price, once again, is called the strike price or the exercise price. And I have an example or two as we move through the slides. All right, so here we have this slide cut in half, call options at the top, put options at the bottom. When the underlying asset is a share of stock, so when the stock price is less than or equal to the exercise price, the buyer, it will not exercise the option because the payoff would be 0. Let's take a quick example. Suppose we have a call option in which we have the right but not the obligation to buy a share of stock at $100. Well, if the stock price at expiration is $50 per share, why in the world would you ever exercise the option and buy the share of stock for $100 when you could go to the New York Stock Exchange and buy it for $50? So what happens then is that the buyer of the option allows the option to expire and loses the entire premium. The call option seller or the call option writer gets to keep that premium. What did I say it was earlier? $10 or something. Oh boy, on the other hand, if the stock price is higher than the exercise price, so think about this, if the stock price is $120 on the expiration date of the option, what do we have? We have the right to buy at $100 when in fact we would go to the New York Stock Exchange and have to pay $120. So of course we're going to exercise the option. We're going to force the writer of the option to sell us that share of stock for $100, and that share of stock is worth $120. Now, there are a couple really cool things about what happens on the expiration date of the option. Let's go ahead and suppose that you write the option to me. I'm the buyer of the option, and exercise price is $100, and the stock price at expiration date is 120. So this is an option that's known as being in the money. All right. So what am I going to do? I'm going to knock on your door and say, hey, I'm Jim. Remember me? I have this piece of paper. I have this option that says you have to sell me this share of stock for $100. Now, here's the deal. As the buyer of the option, as the buyer in this derivatives market, do I really want to own that share of stock? And the answer to that question is I might. I might want to own that stock, but I probably don't. Now, the flip side of that is you as the writer of the option, do you own that share of stock when you sell me the right to buy it from you? Now, if you're a big financial institution, you probably own that share of stock. You might own that share of stock, but you might not. So look what happens on the expiration date of the option. If I come knocking on your door and say, I want you to sell me a share of stock for $100 that I don't really want, I'm going to have to go to the New York Stock Exchange and sell it for $120 after I pay you $100. I make $20. So I'm knocking on your door and you look back at me and you say, wait a minute, this dude wants me to sell him a share of stock for $100. I don't have this share of stock. So I have to put on my intercom button. I have to say, hold on, Jim, I'll be back in a second. So then you have to run to the floor of the New York Stock Exchange and pay $120 for that share, and then sprint back to your door and you open it up. And I look at you and I say, I don't want that share of stock. And you say, well, why didn't you tell me that before I drove to the New York Stock Exchange? You see my point? I've said this to you in many other videos. Look, most derivatives contracts are settled in cash. What would be the easiest thing for us to do? When I knock on your door, you don't even have to open it. You could just slide a $20 bill under the door so we would never even have to talk to each other. So it's much easier to cash settle than for us to go through all that stuff in the secondary market. So look at my first circle point there. The payoff is going to be the difference between the 120 and the $100 exercise or strike price. Now remember, if I really want that share of stock, I can force you to sell it to me, in which case you might own it and you could sell it to me, or you're going to have to go to the New York Stock Exchange and get it to sell it to me. It really is based on my principles and what do I want. And most of the time, I'd rather have the $20 than that share of stock. Because remember, I'm an investor and I buy stocks and bonds and credit default swaps and commodities. I buy all sorts of stuff. I probably have a well-diversified portfolio, so I probably don't need that stock. All I wanted to do was bet that the price was going to rise. Now, let's go like this and flip that on its head for a put option. I don't have to own that share of stock when I buy a put option from you. I could own that share of stock. That's called a protective put, by the way. I could own that share of stock, but I probably don't. All I'm doing is betting that the price goes down. So let's do another quick example here. Suppose I buy a put option from you. Let's just pick a different exercise price. Suppose it's $200, right? I have the right to sell a share of stock to you for $200. Now, if the stock is trading for $300 on the expiration date, then I'm going to allow the option to expire. If I own that share of stock, why would I sell it to you for $200 when I could go to the New York Stock Exchange and sell it for $300? There's the option sense of what this contract is. On the other hand, suppose the price falls to like $40 or $50. Oh my gosh, now I'm excited because I have the right to sell you this share of stock for, what did I say, $200 when the price is only $40 or $50. Oh my gosh, so that's a great deal, right? So the put option buyer, which is me, benefits when the prices fall. So let's go back to this one here, right? And the buyer of the call option benefits when the prices rise. Those are the two left-hand side graphs. Oh boy, let's take a deep breath. That was lots and lots of talk from me for one slide. Remember what I said at the beginning, that there are lots of different kinds of options. So you can buy an option on a share of stock, which we've talked about and which lots and lots of people know. You can buy options on currencies. And this is really important for global investors and for international firms who generate cash flows in multiple currencies. I mean, let's suppose that you buy a German bond and you get lots and lots of coupon payments and you reinvest them in the German bond market so that at the end of 2 or 3 or 5 years, you got this big sum of euros parked in a German bank, and you repatriate those back to the United States. I live in Pennsylvania, so if you repatriate those back to the United States and the exchange rate has moved against you, that big pile of foreign currency becomes a small pile of domestic currency. So of course, currency options are great hedges for global investors and also for international firms, like Coca-Cola, who generates about 80% of its operating cash flows outside of the United States. Of course, there are things like index options. You can buy a call or a put option if you think the entire market is going to go up or down. Makes perfect sense to be able to buy an S&P 500 index option, right? A call or a put. And then there's a really cool thing here. There is an option on a futures contract. I always use the term double derivative to my students in class. I've never really seen that written anywhere, but it's a double derivative, right? You're buying the right, but not the obligation to enter into a derivative futures contract at a specified price. And of course, these are the main 4 types of options, and there are options on other kinds of things. One of the cool things that I like to tell my students, and you guys should know this from paying attention to me, I'm a sports fan, and so these players, they might sign a 4-year contract and then they might have an option for a 5th year. So player contracts have options. If I write a novel, some movie star producer might come to me and say, "Hey Jim, I like your novel. I don't want to buy it and make a movie, but I'll pay you for the option, for the right to make a movie out of your book." So there are lots and lots of options that are out there. How about what happens at expiration and these exercise prices and or strike prices? First of all, exchange traded options can either be American style options, which can be exercised at any point during the life of the option, or European options, which can only be exercised on the expiration date. Now, one of the fascinating things about these American options is that although you can exercise the option at any point during the life of the option, the overwhelming majority of times you're not going to exercise your option before the expiration date, because options have time value. Now, there might be some unique circumstances where there's some unsystematic things going on inside of a particular stock that you might do this, but the overwhelming majority of cases you're not going to. On the expiration date, the choice of whether to do something, exercise the option, or do nothing, allow the option to expire, has everything to do with the relationship between the market price of the option and the option's strike or exercise price. And there's a table of a bunch of Facebook call options. Top one is call options, and the bottom one is put option. Notice that the exercise prices are determined in regularly small intervals. If I wrote an option and the share of stock was currently trading at $100 per share, I wouldn't pick an exercise price of $3, right? It doesn't make any sense. I wouldn't pick an exercise price of $300. So the writer of the option dictates what those strike prices are going to be, and they're typically hovered a little bit above and a little bit below the current market price. And then there's lots of stuff there over in the right columns, things that you see for stocks and bonds and futures contracts, like, the change and the percentage change and the volume and bid and ask and all those good pieces of information. All right, here's a slide on moneyness. So options can either be in the money or out of the money or at the money. And so obviously an at the money option is when the market price is equal to the exercise price of the option. That's an at the money option. But most of the time the market price is going to be either above or below, and it depends on whether it's a put or a call option. So go ahead and skip all the way down to the bottom there. A call option, suppose we have the stock price is trading at 100, exercise price is 105. So in this case, for the call option, the exercise price exceeds the stock price. That's going to be known as an out of the money option. We have the right to buy at 105 when we could go to the New York Stock Exchange and buy at 100. There's no motivation to exercise that option. That's out of the money. For a put option, suppose we have a stock price of 50 and an exercise price of 45. Well, we have the right to sell at 45, but we could go to the New York Stock Exchange and sell for 50. So this is another example of an out of the money put option. Now this becomes more interesting when we break the option premium into its component parts. All right, so let's go down and look at my example first, and then I'll work my way back up. Let's have a call option. There's a stock price of $100. We have an exercise price of $95. All right, so we have the right, but not the obligation to buy at 95. When we'd have to go to the New York Stock Exchange and buy for 100. This is an example of an in-the-money option. Let's suppose the option price or the option premium is $8.21. And by the way, we'll talk about how you compute that $8.21 in some other chapter. Excuse me. But let's just go ahead and suppose that the premium is $8.21. Just agree with me. Just trust me that that's a reasonable price. Well, that $8.21 has two components. It has an intrinsic value. It has an amount that's determined by how much the option is in the money, right? We have the right to buy at 95, price is 100, so that's $5 worth of intrinsic value. Think of intrinsic value as like a core value, the true value, the underlying value, okay? So that's $5. Then the remainder, $3.21, is called time value. So look at that little simple equation I have in the middle. Option premium has two components. It's equal to intrinsic value plus time value. Now let's take a deep breath and pause here for just a second. Now I gave you an example of an in-the-money option. How about an example of an out-of-the-money option? Suppose I go back to this slide here. What did I have? I had a call option. Price was 100. Exercise price was 105. All right, so I want you to think about that. That's an out-of-the-money option. That option is not going to have any intrinsic value. It's going to have an intrinsic value of 0, but it will have some time value. So that's important. All options have time value. Only options that are in the money will have intrinsic value. Now, there are lots of derivatives that are not standardized. So let's look at some non-standard options. First of all, let's look at these flex options, flexible exchange options. These are exchange traded options on stock indexes. All right. But we can always go out and buy a call or a put option on the S&P 500 index, and that's a standard contract. But let's suppose that we wanted to do something else. Let's suppose we, as the buyers of this option, approached a large financial institution like an exchange, like a stock exchange or a bond exchange or an options exchange. And we said, you know what, we want to buy an option. But what we want to do is we want to be able to change our mind over the life of the option, okay? We want to have the right, but not the obligation, to adjust the exercise price, either up or down. We want to have the right, but not the obligation, to adjust the expiration date, either forwards or backwards. Oh my gosh. So of course, I mean, when you walk into a financial institution and you say, I have a bunch of money, can you do something for me? I mean, that's what they do. That's their business. So they're going to say yes, and they're going to arrange this contract. So that's what a flex option is. It's very much like an exchange traded option on a regular old S&P 500 or a NASDAQ 100 index, but there's lots more flexibility. Now, remember that if we buy a regular old index option, there is no such thing as a true financial product like the S&P 500 index. I mean, it's really just a manufactured piece of paper from Standard & Poor's, right? I mean, it's extremely important, but other than the fact that it represents the performance of 500 stocks, it's not like a share of stock or a bond. But with an ETF option, ETFs actually, and we talked about this in a previous video, ETFs actually go out and buy the shares of the underlying index or the underlying sector. And so you can actually get an ETF option in which the settlement is not cash, it is delivered with the underlying shares in that ETF. And so this is a cheap way, at least initially, a cheap way to invest in ETFs. And you get the actual underlying shares. So in the end, you get some well-diversified portfolio. Now, these are fascinating weekly options. And there's no reason why there couldn't be monthly or daily options. I mean, daily is a little bit too short, but these weekly options are short-term in which their expiration dates are created typically on a Thursday. And then they're sold either that Thursday night or the next Friday morning, and then they expire the Friday of the following week. Now, these binary options, these are really cool things. I'm guessing that those of you who are politically sensitive and politically aware will know that you can actually go to a web page and you can bet on future political outcomes, like a particular governor's race or the presidential race. And these things are all based on values from 0 to 100. And sometimes it's, 1 penny to $1, and sometimes it's $1 to $100. But they all have, from 0 to 100%, let's say. And so you might be willing to pay, let's say, $27 today because you think a particular presidential candidate is going to win the election in the United States in 2020. And if you're right, that payoff is $100. If you're wrong, the payoff is $0. So it's binary. You either get it all or you get nothing. And so these binary options in the options market are exactly like presidential elections. And so what will happen is that you will say something like, you know what, that share of stock is trading for $100 today. I think that it will be trading for more than $120 in the next year. All right, so you pick a number, you don't pick a number, you buy that option. Maybe it's $28, maybe it's $42, maybe it's $57. But if the stock price at expiration is above, what did I say, 120, you get $100. If it's less than 120, you get $0. So the binary payoff is that you either get it all or you get nothing. You either get 100 or you get 0. So however these things are structured, it's always good to think about them as terms of 0% and 100%. And then you can even bet on over in the fixed income security market. You can bet on credit events like, hey, you know what? I think that company over there is going to declare bankruptcy by the end of the year. So you pay $12 for that option or $82 for that option, whatever it is. And of course, the amount that you pay depends on things like the credit rating on the bonds. It depends on things like the price of credit default swaps. It depends on lots of things. What's the likelihood that this company is going to actually declare bankruptcy? So if they declare bankruptcy by the end of the year, then you get $100. If they don't, then you get $0. So you lose all of your investment. And then there are deep out of the money options. And so these things will only ever end up in the money if there's some huge price movement in the underlying asset. And so these are popular because, of course, since they're deep out of the money, they have no intrinsic value. They're zero. And their time value might be like 5 cents or 15 cents or 22 cents. So you can invest you can invest a small amount of capital today. And if the stock price goes up to, some number, whatever it is, you can still make money, even if the option never, ever gets anywhere near of being in the money. So you could buy at 22 cents and sell at 44 cents. You're still doubling your money, but you're only doing it with a small amount. Now, of course, since these are over-the-counter markets and organized exchanges, there has to be somebody out there who is helping you execute these trades. So there's going to be a market maker, there's going to be a bid price, there's going to be an offer price, sometimes it's called an ask price. Commissions are going to be charged by your local retail broker around here. Most of the time it depends on the size of the trade. And of course, just like when we invest in mutual funds and we invest in hedge funds, we have to be very, very sensitive to the expense ratios. Commissions, of course, reduce all of the investors' returns. Now, remember that I said somewhere in the beginning of the slide deck, I said, I could become a writer of an option. But think about that. If I'm just Jim, I'm regular old Jim, a college professor with minimal means. If I show up on the exchange and say, okay, I'd like to write this option, and lots of people are attracted to it and they pay me $1 billion. What am I tempted to do? I'm tempted to take that $1 billion and go over there and get a disguise so nobody ever sees me again, right? So what happens is that for other than large financial institutions, the option writers are probably going to be required to put up some type of collateral. So I could show up and I could write that option for $1 billion, but whoever's in charge of that exchange is going to say, you know what, Jim, I'm not so sure we trust you. Keep the $1 billion here with us just so that we know what's going on with our money. Okay, and that takes us through chapter 11. That was fun for me. Next up, we'll talk about some properties of stock options.